Welcome back to the Be Wealthy podcast. My name's Brett Tanner, and on this podcast, we aim to do two things. Number one, we want to give you strategies to grow your business. Number two, once you're more successful and have more wealth, we want to show you the things that you can do with that wealth to create the life that you want. Today's episode, I jump in with my good friend, Kyle Fuller, and we're going to talk about all things infinite banking, how banks play a radically different game and how you need to think about it, and a couple interesting ways that you could reach out and learn the strategies of the wealthy. With that, let's jump in with my good friend, Kyle Fuller. Kyle, welcome to the podcast.
It's an honor to be here, Brett. I'm really looking forward to this.
So Kyle, we met each other, I'm going to call it 5 or 6 years ago-ish. I actually was sitting down with you and Factum Financial does lots of things, but you guys, in my opinion, are the leaders in the life insurance education space. And as we go through this today, one of the things I want to break down is I talk about this all the time. Life insurance is the most confusing, most misunderstood. It's actually not the most confusing. It's the most misunderstood industry out there. I can't think of anything that would be more misunderstood. And what I fell in love with about what you do is it's the education. The education that you put together and show folks all aspects of their financial world, specifically the things you're doing with Tough Money, which we're going to get to all of that here. So just, man, thanks for being here. And you have so much. We're going to have a hard time packing all this in to the next little over an hour. But I want to start with your journey. Kyle, we'd like to take all of our listeners through that journey and really understand, where did Kyle come from, right? He's built this massively successful business, but where did it all start? So go back to your 10 years old. You're talking about money around the family dinner table, and how was it at the Fuller household?
Yeah, I would say, money was a subject we did not talk about a lot. I knew my dad worked really hard because I saw it every single day. And, so he was always working hard, but it was never really talked about at the dinner table. And as I got a little bit older, I started to learn that, like, 2 generations prior, my great-grandfather was a mega multi-millionaire, owned a helicopter, 50 gas stations. And when I started learning about this, I was like, well, where is all that money? Because he had built it in his generation, but my dad grew up really poor. And so it was like this wealth transfer did not happen. And money conversations just were not happening in our household on a regular basis when I was a young kid.
Was money scarce? Not did you have it, but when they thought about it, was it like a scarce resource that if we ever found it, we got to hire it and bury it, never tell anybody about it? Or was it like, hey, there's some money out there, we just got to figure it out?
I think my dad was always optimistic and entrepreneurial. So he was an architect by trade, so he owned his own business. And so you got to see that. And that was really good for us kids. But money was always tight. I'm the second oldest of 11 kids. So it's not a cheap endeavor to raise and support that many children, especially when you're, a newer business owner and just getting that started. So it was there, but there was never an abundant amount of resources. We can just put it that way.
Okay. So then you're growing up and you get to experience the great financial crisis. And that was kind of that really shaped your perspective. Now, how old are you when the GFC hits?
So I'm 19, 2008. I graduated high school 2007. And, I watched my dad, Brett, work so hard for 10 years, building his business, raising all of us kids, getting us out of kind of a ghetto area in Mesa, Arizona, and moving us to a nicer neighborhood. Like, we watched all these things happen. And he had saved up $500,000 during this 10-year time period. So did everything right by the business, everything right. And then when that event happened, my parents were over leveraged in real estate. We're not holding enough cash reserves or liquidity. And when that shift happened, it took us from being like doing pretty well to almost bankruptcy in a matter of months.
Wow. And you're 19 years old and you're kind of getting you're a young adult at that point. So you're getting the adult view of where money, if you don't have the right liquidity, let's just go there, right? If you don't have reserves to survive whatever timeline the problem is, right? So if it's a 3-month problem, you got 4 months reserves, you're great. It's a 3 months problem and you got 2 months reserves, you're toast, right? I mean, it's simple. And so our listeners out there, we talk about it in Be Wealthy all the time. We believe 6 months is like bare minimum. And we talk about it through your burn rate, Kyle, which is whatever amount of money you naturally spend.
Yeah.
I'm not telling people to kill their Netflix and, turn off every luxury they possibly have in their life. You're naturally spending a certain amount of money. Take that amount times 6. You need that in a saving somewhere liquid. Pick your vehicle of liquidity. And ideally growing that to 12 months, in my opinion. So take me through that. So you watch your parents go through that. What lessons do you learn as you go through that and see it from a firsthand?
Yeah, it was one of those things where, I've heard you talk about you have some scars on your back from 2008. So does our family. We had to move from the house we were living in, went to church with everyone in the neighborhood, very close. We had to kind of pack up from that house and move across the street into a rental because we didn't know if we were keeping that house. Like that was not a fun time for our family, but it also changed who we were as a family, right? Some of those events, they just make you tougher, and we got closer together. But I mean, I still to this day have no idea like how my dad survived that. That cannot be a fun time as the breadwinner, kind of the leader financially of a family, to experience that. And it rocked his world for a while. We'll put it that way. Like it was not an easy time for him, but some of us, we kind of just banded together as a family. And those of us that were already working, that had some resources, we kind of all just chipped in and we made this thing work. And, today we're closer than ever as a family, which is really cool.
That's really, really cool. So if you were talking to someone and going back, would you say, what would be some of the, like if you could go back and if we had a time machine and you were going to like fix it, what would be the things that we could learn, right? Reserves being one, right? And I mean, I could give my own, I have 500 of these for the Great Recession that I could, my scars that I could say, hey, I could do this. I understand that part. When you look at, are there a few lessons you could distill that you go, man, this is what goes through my head today when I think about it or when I'm talking to, your clients?
Absolutely. One of them is you got to really know your investing criteria. We picked up so many great things that we've learned from you in Be Wealthy, KW Wealth, about, risk, return, noise. How much of this are you looking for? What type of assets are you going to buy? Why are you buying them? I think most people don't really have an investing criteria. So they go out and they just kind of, they speculate is honestly what it is. And then they consistently lose like every 5 to 7 years. And we're wondering why this is happening. But if you don't know the game, losing is going to be a part of that game. So we did not have an intentional investing criteria, number one. And then we didn't have the proper foundation built to support us, not if, but when events happen. And part of that was we didn't know what our cash reserves needed to be. Because at the exact same time that our family was experiencing a lot of pain and discomfort, other families survived 2008, 9, 10. And then when the ones that had resources, they bought real estate in the Phoenix area that we might not ever see prices that low ever again in our lifetime. I mean, it was like they created fortunes during the same event where we were experiencing, call it near bankruptcy. Same event.
Same event. Well, I love what you said there about investing criteria. So one of my lessons when I look back at 2008, I was buying real estate, which was, the thing to do. But my criteria around what I was buying and why and the risk, right? That wasn't as thought through, right? My 28-year-old brain's investing thesis was pretty basic. And, I got the opportunity once I got through it on the other side and I had resource, I weathered the storm, but I got some pretty good scars. I got to go look and learn, like, okay, what houses, what real estate investments worked great, which ones didn't, why, and part of it goes around the asset class. And do you understand why? And I think, Kyle, to your point, what people go out and do is their neighbor's doing something, right? Or now social media, you see, oh my gosh, they're buying some, crap coin that's some crypto coin, or they're doing this, or they're getting an NFT or whatever the thing is. And they're like, well, I got to do it because people are doing it. And that is the dumbest reason that you could ever do anything, is because someone like, and trust is doing it. By the way, if someone like, and trust is doing something, sit down with them and ask why. Vet it against your own thesis. It might be genius, But if you don't even know why they're doing it and they don't know why they're doing it, which is probably the case, it's just risky. And, we talk so much about your unfair advantage, right? Your money should be placed to where you know more. Like if the things I do in real estate and the investments I do today, if they were in the stock market, I'd go to prison for them, right? Because it's insider trading. In real estate, people clap, right? It's just knowledge and the industry so well, or what's happening with a single house because I marketed to that customer and they told me they want to sell their house or whatever. And so I think that's a great one. I think people, they don't have an investing thesis around an asset class. Then they don't have the reserves to match the timeline that they would need. So when you think about your investments today on an investment basis, how do you think about the reserves needed? I'll ask you two questions. Number one, where do you go to get education around asset classes when you think about that, if you're talking to our audience? And then secondly, what kind of reserves do you think they need?
Yeah. So when it comes to just like, what are we going to be investing in? To me, you got to start with the end in mind. So what's the type of life you want to build? For us in Factum, our community was built off this principle of living abundantly in all areas of life, spiritually, personally, family, in your occupation. And the financial area with abundance is what funds everything you want to do in the other areas of life. So as long as we can agree that's what I want, I have to be very selective now in what type of investments I'm going to pursue that make that reality happen. So I've had a Roth IRA since I was 16, Brett, and that was a retirement vehicle, not self-directed. We'll probably talk about that in a minute. But so there was no control. I had no control over it. And the purpose was you're going to fund this now with money. And at 60, you can enjoy this and then travel and then do the things that you want to do. The problem is I got young kids right now, Brett. They're only this age for this year. And if we don't do stuff now, we miss maybe the greatest opportunities of our life. And so I learned that my investments have got to produce income or cash flow. So that's like non-negotiable. I don't even look at investments that just accumulate for later. I want investments that pay me now because it supports the vacation I want to do, the truck I want to drive, the home I want to live in, all of those things. And so I think we got to get real clear with like, what do you want to do with your life? And then find the investments that directly support that. And that makes it really easy to say no to a lot of things. And it really narrows it down. From there, if we go to like the returns, risk, noise, I learned a valuable lesson trying to buy into a business a few years ago, 50% equity partner. It looked amazing. The two guys I was getting into business with were total studs, tons of integrity. This looked awesome, but it required so much more time than what I was thinking it would have been. And so it became way too noisy, and it took me away from doing the things that I actually love doing, which is teaching people about life insurance, tough money, infinite banking. And so I had to get out of the equity partnership there, and I've turned it into a loan. And it's been one of my most profitable loans to date. And I got all my time back with zero noise. And so I learned there, like there's a certain things I just won't go pursue now. And so I tend to look for very low risk, decent return, and almost no noise are the investments I'm looking for.
I think that's, there's so much genius in what you just said, right? That we wake up and people would listen to this, they go, Kyle, but it was a business. Now you've got two businesses, right? If one's cool, think how awesome two is, or 10, but it depends on what resource you're providing, right? 3 resources in life we always talk about. You got money, talent, and time. And, when you start everyone starts their career the same way, or I started my career the same way you started yours, which I had lots of time and no money, and I didn't have a lot of talent. Maybe you might have had talent. I didn't have any. I just had time. And as I invested the time, I started getting more talent, right? And so as you get more talent, you can kind of pull the time back. Then as you get money, you could pull the time back, right? You can invest that's people or whatever. And so, when I look at a thing, I'm looking, okay, I'm happy to provide money. I'm happy to provide talent or influence. The most precious resource we all have is time.
Yeah.
And I don't think people look at it that way. They're like, oh, we'll just take a little bit of time. But, well, everything requires management. Everything in your life, Kyle, you buy. I would say this, any purchase over $500 requires management. Anything like this, I'm filming today on the greatest, I got to tell you, I got this new thing I've got, my mobile, I'm filming on my cabin right now because I just closed on that resort last week, conversation for another day. But I got my little mobile podcast. My whole studio fits in this right? But I've got to manage it, right? If I don't charge it and I don't do those things, it doesn't work. Everything in your life. So at some point, there's this saying, if you get really, really wealthy and you buy enough things, one point you'll be a slave to your actual things. Right. If they'll actually own you, because you just spend your whole day trying to manage the things. And so I love what you said. You got to get real purposeful. What kind of life do you want? And what you said was, hey, passive income is really the thing, because I want to make investments, but even though there might be an investment that I hold today, like Tesla stock, it doesn't dividend or cash flow today. So today like you said, I got little kids. I want to be able to have cash spin off of my investments that ultimately exceeds my income, so that I could take 100% of my working income and go do really cool things and great experiences with people and live an epic life. Right? And I think people get that all in that weave of what's more important? I get that question all the time. What's more important, net worth or cash flow? So if I only had to pick one, cash flow. Right. Now, usually they're linked, right? There's some sort of link. But, I've given that story of, I have two buddies that are both worth about $50 million. One owns 15,000 acres, farmer. One has the 50 million in all cash flowing assets. I'm going to tell you, they live two radically different lives, right? One guy lives just like you think he would, right? It's the greatest. It's all it's literally like an Instagram reel. That's not one of those fake ones. It's absolutely real. The other guy has love of the game, right? It's all a love of the farming and that thing. Yet, when you really look at it, you go, man, there's zero cash flow. It is a super lean, bad crop year. You could get knocked out of the game. And so the point you made is just so good, and I want to just anchor it in that we got to get real clear on what we're even going for. Like, what is your objective? What's your ideal life? And then what are the things that fit in there? All right, so go to your, Kyle, you got this IRA at 16 years old. But your early influence, you had this, I think, the same influence that I did, but you got hit by the rich dad, poor dad, I'm going to call movement of that time. Because I'm like almost 10 years older than you, and I got hit, probably the same time. I got hit in my early 20, maybe 19 or 20. So when did you get, what was that spark that kind of sent you down the road that I'm going to do something different with my career, with my money?
Yeah. So, I didn't I enjoyed high school, Brett, but it wasn't my passion. I was a C student. I just kind of did what I needed to do to just kind of finish, but I didn't love learning back then. And I definitely didn't enjoy working. I would work for my buddy's dad who owned a landscaping company, and I would split gravel jobs with him, and I'd make decent money. And, at that time, my grandfather set all the grandkids up with a Roth IRA, put $1,000 to do it, and just said, hey, listen, this is up to you from here. And it was one of the greatest lessons, because he's like, if you start early and you start funding this thing now, it's going to grow tax-free. And if you start now, you could retire when you're 40. So going to high school, not enjoying working, hadn't found my passion yet, and I didn't enjoy learning in the public school system. Retiring at 40 and golfing sounded like that's the greatest thing on earth, right? So I would work these jobs and save 50% of my income and put it into this Roth. And when 2008 came along, I watched 40% of that Roth just disappear. It was gone. The value was gone. And so I didn't have a good relationship with the company managing it, but the question I asked was hey, what happened to this money? And what they told me was, oh, don't worry, this is part of it. You're going to win, you're going to lose, but you're young, so you can recover. And my point back to them was well, what if I'm 58 and this happens? What if I'm 2 years
Your toast?
And I go from $1 million to 600,000 in 6 months? That drastically changes things. So it kind of just made me pause. And about that same time, I was reading The Total Money Makeover by Dave Ramsey. Kind of if I just stay out of debt my whole life, I'll be a millionaire for sure. And then at the same time, my dad gave me Rich Dad, Poor Dad. So it's kind of all these things at once were just floating in my head. And I definitely leaned more towards the rich do things not differently than poor people. They do the exact opposite. And so that's what I started looking if this is the traditional path, I just don't think this is my path. So I started looking, and I didn't go to college. So what I did, Brett, is I would go to networking events, like a Be Wealthy, except I couldn't afford that event back then. So I would try to go to these networking events. I would try to identify a millionaire in the room, probably one of the ones speaking. And I would say, hey, Brett, can I take you to lunch? I'll buy. I just have some questions for you. And 95% of the time, they were very open to that. So I'd sit down with them and be like, hey, what do you wish you would have done at my age? What should I be aware of? And that's where I got kind of my formal education around money. And that's what led me into just kind of alternate investments, cash flow, different types of mentality with wealth building that were very opposite from, let's say, the typical financial planning route. Nothing wrong with that. It just didn't fit the way I wanted to live my life.
So wait, how old are you now? How old are you that you're just going to networking events and sitting down with wealthy people? What age is this?
That would have been right out of high school till I was 24. And that's when I found whole life insurance, infinite banking. And that's the piece that I was looking for. And yeah, so that would be like the next transition of my life.
How many people do you think you sit down with? How many people you're showing up at these network events? You're an 18 to 24-year-old kid. You're just, well, first of all, how do you even find these events? So you're like, because the internet, I know for all of our viewers here today, back then, there wasn't, you weren't going to go on X or, and just find your event, right? There was none of that. So how many events did you go on? Where did you find them?
Yeah, so I had a really good buddy of mine, and early on, we both, like 16, 17 years old, we were like, hey, we're going to be billionaires. That was just our conversation, right? Like, we're going to do everything together. This is what we're going to do. So we both have strong roots here in Arizona. So big spheres of influences, lots of family here. And so it was fairly easy to find like wealthy mentors that we knew going to church or just like, in real estate, whatever it is. So yeah, there was not a whole lot of internet presence. So it would just be random events we would find, a networking event, a real estate investing summit that we knew someone wealthy, and we would just show up to these. And then it was kind of like, oh, well, here's this guy, Brett, can I take you to lunch? And most of the time they're very open to that. They want to give to the next generations. Right? Of course, a lot of times they see like the younger version of us when that's happening. And they're like, yeah, let's talk. And so it was just, call it a grind. We would just go out there and find, but we were always looking. I think that's the biggest piece. If you're always looking for it, you'll find it.
And so how many of these did you go on? How many people did you go sit down with?
At least a dozen, like probably 20, 30 events. And of those 30 events, I probably found a dozen good, actually wealthy, got it dialed in people. And then it eventually led me to some of my first two mentors, which was a very wealthy orthodontist. So he had invited me like, hey, if my wife worked for him at the time, Brett. So he was like, if Kyle's looking to, learn about money, have him come down to my office after hours. So he would teach wealth building after hours at his orthodontic practice to other millionaire dentists, surgeons, orthodontists. And then it's 25-year-old Kyle sitting there. I make almost no money. And I'm just like, this is the greatest room to be in. And I mean, and I got to learn from these guys that were 60 and 70, Brett. Like, we've talked about gray hair matters. I think that's an ability the younger generations are starting to lose. There's so much we can learn from people in their 60s and 70s that have done everything we can think of. And they're like, let me tell you exactly how that's going to pan out. Here's what I wish I would have done. And it was like the greatest education around money.
So first of all, I think every listener out there, right? But especially if you're 18 to 24, Kyle, I actually couldn't think of a better activity that someone could do would be to go sit down. And so I want to go there because I want our listeners I did a version of this. But I want to go. So you're sitting down, you invite a millionaire. You're like, hey dude, you're successful. I'm not yet. I want to be where you are. Could we possibly sit down with an hour? Can I take you to lunch? Yep. Then you get to the lunch or however you get them there. What's the conversation sound like?
Yeah, so I think the most important thing was to remember why this was happening. I just got crushed in 2008 and I lost like $4,000 in my Roth IRA. It wasn't like a ton of money, but to a high school kid, it was like, I could have done a lot of things with $4,000 and I chose to save it and then invest it. And so it hit me hard. Like that's a lesson I was looking to never experience again. And so when I would take these guys and gals to lunch, I would just ask them, I say, hey, listen, what's the most important thing that you learned about money? If you could go back and be my age again, what would you have done? And what should I be aware of? And they were always very open with it. And that was generally the questions. And then we would just sit there and talk like normal human beings and learn about their life. And so I'm a high nurture individual. I'm really big on relationships. So I genuinely want to know about their life. But those would be like the three fundamental questions. What do you wish you would have done earlier? What should I be aware of now? And basically that was the framework.
Wow. I can't think of something, and I'm sure that after this, the people said, hey, if you want to follow up or if you got questions, send them to me. I mean, I've had the same experience you have, which very, very successful people that I reached out to early on were so giving of their time. They were so willing to help. And to your point, I think there's a variety of ways to learn, right? One, you could read about stuff that happened, which is super valuable, right? Others' experiences and how they overcame things. There's just raw knowledge in books. One, you could live it, right? Like you and I lived the financial crisis. The other way to learn, which I actually think is the best way, is to learn from others' experiences that you didn't have to go through. Like I spend, a lot of my friends are today 60 plus years old, and that's probably always been the case since I was even in my early 20s. Because I found that they were so wise, right? Like gray hair, like life experience matters. Scars matter, right? Anybody that's like, oh, I got to the top of the mountain, I have no scars. I'm like, well, I don't know what mountain you're climbing, but the mountain I've been on, been pretty treacherous. Right? We've fallen down a couple times. I got scars. I got some joint issues. But learning from their experience, right? Even to this day, I'll ask, hey, like a super successful, entrepreneur who's 75, I can learn so much from that. Hey, if you could go back in time and you were 44, my age, what would you do different? What are your regrets? Right? Were there any things that if you could go back and like their insights, no, I don't have to agree with it. But Kyle, we could learn so much from the experience of others. You and I don't have to go, because the downside, Kyle, if you and I get to 75 and you got regrets, you can't, there's no time machines yet. Elon hasn't figured that out, how we get to go back in time and get to replay the game. Like, I was going to think of that movie. I can't even think of that movie. You know that Tom Cruise movie where he dies like every day and then he gets reborn and he has to like survive the day. And it's like The Edge of Tomorrow. I'm going to go Edge of Tomorrow, and I don't know if that's right. But we don't get to go back and do it, right? So we only get one shot at this thing called life. I love what you did. So you get this knowledge. So now here's all these millionaires. I'm sitting in this orthodontist meeting with really successful people. I'm 24 years old, and you go, and he now was your first really intro, right, to the infinite banking, right? That was the guy that kind of sparked the idea. Is that right?
Yep. Yeah. So I'm sitting in this room, and I'm looking for, there's got to be a different way to build wealth out there that there has to be, right? And so as soon as he started teaching, and I'm just sitting in there listening, right? Like I'm not raising my hand, I'm not talking, I'm just listening in this room to all these successful business owners, and they're learning from his life experience. And literally he's like, I would trade all my wealth now to go back and be 20 years old with nothing just to know this earlier, right? And so, and that's experience. That's why you go talk to people that have life experience. And so he's talking about this concept, this book actually right behind me, Becoming Your Own Banker. And it is so backwards from the way I was taught to think about money. And so, as soon as he was done teaching, I'm like, where do I get this book? Can we go to lunch? I've got some questions for you. And, he was very open to that. So when we're talking and I'm telling him, hey, Dr. Dykman, I'm trying to learn about money. And he's like, well, Kyle, if you want to learn about money, why don't you go to like the top of the food chain? And I'm like, well, who's that? And he's like, it's commercial banks. Banks are some of the best players in the money game, and they do things really differently than we do as employees, self-employed individuals, business owners, or investors. The banker mentality is very different than the other players in the money game. And so when I started looking at that, I'm like, this is what I want to do just on like a personal level, right? How do we do what these companies are doing, but we just do it at a family level? And as it was like one of those things, as soon as you see it, I got to start teaching this, because it was exactly what I was looking for. And I was very passionate about it. And that was the early start into my life insurance career as well.
So you go from there and you learn this, radically different way to think about money. And by the way, that book, everyone, I very rarely make wide sweeping comments like everyone should do this. Everyone should read that book, whether they want to get into the life insurance game or not. Becoming Your Own Bank, get the most recent edition. How many years ago? It's an old book. When was it first written? The first edition, what year?
2000.
Okay. I thought it was even older. But so 25 years old at this point. And that book will stand the test of time, right? It's in 25 years, it's still going to be this. The content will be might even be more relevant actually than it is today. But everyone should go read that book. So Kyle, for people that don't like, where you're now going down this road, and he really showed you the first concept of infinite banking. So for those that don't know, and it gets super confusing, what is infinite banking?
Yeah, infinite banking is really a mindset and a lifestyle first. I think everyone tends to just hear about it and they reduce it to like some type of product you're buying. And it's a mindset and a lifestyle. So if you're going to commit to becoming a banker, you got to live the banker's lifestyle and mindset. So it is a paradigm shift around how you think about money flowing through your life. So if you think about it, Brett, you got employees who save money with a bank. You got self-employed individuals who save money with a bank. So do the business owners. So do the investors. The banks take in these deposits and they hold it for us. And then they lend out money to employees, self-employed individuals, business owners, and investors. They're touching and controlling the money way more than the other four players in the money game. And so the whole idea behind the concept is, if we know we're going to finance major things in life, vehicles, real estate, investments, college educations, weddings, whatever it is, wouldn't it kind of make sense to start your own private banking system to where you as a business owner or investor can tie into a system you own and control when, not if, you need to finance things in life? And then you kind of recapture and control those dollars in your life, as opposed to sending out a lot of principal and interest to a banking institution that may or may not have our best interest at heart. We'll just put it that way. And
yeah, and so the main idea, the main idea is we all have expenses in life, right? And we all have some sort of income coming in to pay those expenses, right? The way I think about that, and the way you've heard me teach, is like, I believe that every single person, whether they're in infinite banking or not, let's take one step back. Every single person listening to this or watching this is running a bank personally.
Yeah.
A personal bank at home. And I'm just talking about your personal checking account. Why do I say your bank? Well, you have deposits coming in and you have the things going out. Withdrawals. We'll call them withdrawals. That's what banks call them. Does every person have that? Well, yeah. So in that context, you got to ask yourself, well, number one, do I want to recognize that? And do I want to run a really good one or a really crappy one? And the difference at the end of your life will be millions and millions of dollars and likely the life you want, or you could put your head down and avoid it. And what you're saying is there's another way, right? So you take that idea and now you go down this infinite banking route where, hey, there's a tool, there's a way, a strategy. It starts with the mindset of just, I'm a bank. Until then, I'm going to think a little differently about it. And so when they're thinking about infinite banking, the way you presented it, Kyle, there's not a person listening to this is going to go, that makes total sense. I get it. I want to move forward. So what's the next step of infinite banking to kind of start thinking about, that idea? If I'm like, okay, Kyle, I like that. I like the idea that I have a car payment now. I'm paying a bank, which sucks. I don't want to do that. I mean, it doesn't suck. It's annoying, right? I think paying interest to anyone's annoying. Could you give a little, how would that work, right? Instead of paying, and let's set up the scenario. Brett, am going down and buying a car. I'm buying a $30,000 car, and I'm going to put $5,000 down, and I'm going to have a $500 a month car payment or whatever it is. And my interest rate's 8% today. And that's probably pretty close if I have average credit today on a used car. All right, so that's one option, $500 a month. I get that. That's the option that the world views as the only option. Now, how would that work if I had this mindset, lifestyle strategy put together? How is it different?
Yeah, so I think it kind of goes in three phases. Number one, you got to get the banker's mentality down first. If we can think like a banker, we're already going to start looking at money differently. And then the next thing that we really got to get dialed in on is there are rules to banking, right? Just like there are rules to investing. Like you want to follow a criteria. So there's rules to this infinite banking concept you want to follow. And then the last piece, which is unfortunately the most piece that's talked about most frequently, is the product that we're going to use to build our banking system on. And what Nelson Nash, who wrote the book Become Your Own Banker, identified was, because he got in a real estate pinch a long time ago back in the 80s. And so he had a bunch of debt he owed on real estate at, really high 23.5% interest rates. And he's kind of like, where am I going to get the money or the person who's going to buy this from me? And he was kind of like trying to figure out what to do. And then he realized, I've been paying these large insurance premiums for a number of years. and he could go borrow against his cash value from the life insurance company at like really favorable interest rates. And so that's when he's kind of like, what I just did is I just borrowed for my life insurance policies to pay off the real estate. And then he just became the banker and paid back those policies. And that's where the idea was formed, was really back in the 80s with a product that's been around well over 150 years. And so the way I think about this is, if you got the banker's mentality, then there's certain rules you want to follow. And if you insert a whole life insurance policy, not your standard whole life, it's got to be properly designed with the right carrier, and you need a team to run with you so they can show you really how to use life insurance. A lot of people own life insurance, Brett, but they do not use life insurance. And so the situation...
Hold on, let's pause. That's a huge point. I want to pause there. A lot of people, just because you own a tool, there's lots of tools. Like, I got a Roth IRA. Well, I'm like, well, do you have it self-directed? Okay, well, you're at level 1, and there's level 10 in this game. And so it just because you got it, I will be the first example here. So I had a really large policy before I met you. And I would say on the 1 to 10 scale, 10 being, ultimate black belt knowledge, I could trade seats with you and teach this. 1 being, I have a policy. I think I was operating at a 3. Right? Like, I had a policy and I was doing things. But it was like kindergarten level stuff. And when I met you and I sat down, I remember we were sitting at Charleston's. I'll never forget. I was like, no, dude, pull out your, I'm here as a student. I'm here to learn. You go. And you went off for like 90 minutes. And I was like, whoa, there's a whole different world. So just right there, just because you have a tool, if you don't understand it and how to maximize it, and how it could actually be meaningful, you're not even in the game. You're just, and it's that saying we have in D. Well, I said, most people's lives, people listening to this and watching this, their financial lives are junk drawer. And I wish I could whip around and show you my junk drawer behind me. I'm up in my cabin. And it's not that the stuff in my junk drawer, Kyle, if I was to show it to you, you would go, well, that's not junk. I mean, there's a scissors, a tape measure, and keys to stuff. And we've got 10,000 keys. And I don't know what any of them are, but they're in there just in case, we're never going to have a problem. But so I've got this junk drawer, but most people's financial lives are just like that. They got a drawer of stuff. Oh, I've got a life insurance policy. Oh, underneath that's an annuity. Oh, there's the Roth. There's this other thing. Well, there's my bonds that my parents gave me. I got a 30. They got all this stuff. Oh, I got an umbrella policy, got one of those, and no one's ever gone into I've got all these insurance things that are overlapping, and how many times have you gone to the junk drawer and organized it? Not that it's junk, and then actually said, okay, each thing in here, I'm actually going to learn how to use it. And so I just want people to stop there. Like, if you've got a whole life policy, if you've got an umbrella policy, if you've got go understand, what do I have? Cool. What are my options? And by the way, the person that you're talking to may, right? Like, if you're dealing with a normal, financial advisor, keep in mind, you got to also ask how they're compensated, right? That financial advisor wants you just to put more money with them, and they're never going to say, don't self-direct it and put it into something that you know really well, because that'd be crazy. I wouldn't get paid. Sure, it reduces your risks and lands you where you want to get in the future. So I just love what you said, that people might even have they might even have a version of the right policy. But do you even know what you have? And then do you know how to use it? So that was my little rant. I think it was such a good point you made. I had the right policy. I had all the right stuff. Policy design, I had the right thing. But without the right education, doesn't matter, because I'm not using it right, and I'm not going to maximize my opportunity. So I just wanted to keep going.
Well said. It's the same with real estate, right, Brett? A lot of people own real estate, but they don't use it. They don't cost segregate it. They don't create cash flow. You might not exchange. Like, there's so many things you can do with these assets, and it's why you need that wealth team working alongside you. So that family office mindset, which we love. So when you got the banker's mentality, you kind of know what rules you're going to be following with this banking system. When you can save money a lot of different places, a checking account, savings account. There's a lot of liquid safe assets you can use. And this is where the biggest misconception of life insurance comes into play. And the first time I ever heard you talk about life insurance, I knew you knew what you were talking about, because you got up in front of the room, you showed a 10-year-old policy that you have. By the way, everyone, when they see 10-year-old whole life, they're like, I want that. They just aren't willing to go through the first 3 years to get to the 10. It's the same thing in business, right? I love watching Brett teach. I don't want to go through the first 3 to 5 years that he went through to get there, but I want what he has now. And that's just human behavior, right? And so
Yeah.
you hopped up in the front of the room and you said, listen, I'm just going to tell you, if you look at this asset as an investment, you're never going to end up buying it because you won't understand it. And I was like, bingo. That's it. Life insurance is not an investment grade vehicle. If you look at how it's built and the benefits that are in it, it is nothing more than a liquid, safe asset that has death benefits built into it as well. So we'd never call it an investment. And the banks know this, by the way. So it has more to do with a foundational asset. And once you see it there, then you start to go, oh my gosh, this is like the greatest tool to build a banking system off of because it has certain benefits you just will not get in any other liquid safe asset. It just gives you some advantages to the money game. So to your point now, we're saving money with whole life. We still have a checking and savings account, but I might put more of my long-term wealth with whole life. And now I need to finance a vehicle. So I got two options. I can go the most typical route, which is walk down to a financial institution, borrow at 8%, and we pay them interest payments. And here's where like my parents were saying, listen, we don't borrow money, right? We are the pay cash family because paying cash is more efficient. And this rocked my world when I learned this from that orthodontist 11 years ago. He said, when you pay cash and you give up that $30,000 for that vehicle, yeah, we're not making interest payments, but that cash is gone forever. It's out of our personal economy forever. And that carries what's called an interest cost, which means what could we have earned on that $30,000, assuming I could keep control of it and earn interest on it for however much more time I have on this earth, which for me is probably 65 to 70 more years. That's a long time to give up an interest cost. It's hundreds of thousands of dollars. And so here's how this plays out, Brett. We have three options now if we're going to assume the banker role. You can be the saver and you can save up money and deplete your accounts down to zero, constantly interrupting any potential growth, which a lot of people are doing. Or you can go into debt and make payments back to a financial institution and also have nothing to show for it after driving and owning multiple vehicles. If you start saving with whole life insurance, there's a benefit in there called the flexible loan provision, which allows you to say, hey, insurance carrier, I've got $30,000 in this policy in cash value, and it's growing net of taxes like 3 to 4% every year, which is like incredible for a liquid safe asset. And instead of pulling the cash value out of the policy, what we might do is say, hey, would you lend me money from your general portfolio? That's the insurance carrier. And let my money sit in the policy, continually earning interest. So you are using a loan, you walk over to the dealership, pay for the car cash, and now this is where the rules of banking come into play. You got to make the same payments I would have paid to a financial institution. We're just going to send it back to where we actually have some ownership of now, like you said. And if we do that over 4 or 5 years, the growth inside that policy is now at a new high when we're done refilling that loan, and you go do it again, and you do this again and again. And so here's the average numbers, Brett. The average American will drive about 13 vehicles in their lifetime, spend roughly $400,000 doing that, and they will have nothing to show for it at the end of that time period. If you utilize the infinite banking concept with properly structured whole life, you could spend the same 400 grand and have at least $1 million in your control based off kind of when you're starting this. Now that's a huge difference. And what God, yeah, should we stop there for a second?
No, I was just saying, like, that's not like nothing, right? I go from 0 to $1 million on something we're all going to do is a massive change. And we're talking just about cars. Like, you're not going into other areas. You're talking about just cars.
And a lot of people will start by redirecting the flow of money for like some debt they have or large purchases like vehicles. Where it gets fun is where like how you're using it, Brett, is you're using policies to go out and fund investments. You see, when you got that system working to now create cash flow, you kind of get the best of both worlds. You get the strongest, in my opinion, the strongest foundational asset working really hard for you. And then you've got your investing game dialed in. When those two components are working together, you're unstoppable. And
well, I think what people miss, Kyle, to your point. So I just want to go back to this, or keep going, and I want to go back to how this transaction, I want to anchor a couple points.
yeah, let me just the piece that got me so excited is I'm a big family guy. And so when I saw this, I'm like, okay, if we could control all the flow of money in our life, which is different. Bankers think about controlling the flow of money. Investors and business owners, we think about creating new money, right? Like that's what we want to do. And so if I said, my wife and I, Diane, if we could just control all the principal and interest payments that flow through our life, that's going to keep way more money in our control. When you take that to a family level, we got 4 young kids now, but we've been working at this for 11 years. So and that means all my siblings, all 10 of my siblings, my parents are involved with this now. We have built a family banking business now that when any Fuller born in the next generations, when any of them need a vehicle to finance, they will never go outside the family for financing. They'll come into the family, and all of the principal and interest for every vehicle purchased now and any future generation will stay within our family's wealth generation to generation. Now, that took us 10 years to build it. I'll tell you, the next 10 years is we're going after all the mortgages next. And it has nothing to do with investing. It has everything to do with control. Now, you got to have the right conversations, contracts in place. But, I told you early on in my life, my family, money was kind of a taboo subject. Brett, we're like this now. Our family's tight. Our family's tough. We talk about these things. We rely on each other. And it's a concept we call interdependence. We're all working, in our own separate families, but we operate as a strong family unit. And that is a wealthy family mindset.
So I want to go back to your example. So Kyle, the average person, I was doing the payments. That car, $30,000 car, we put $5,000 down, $25,000 borrowed, 8% interest. I did it over 5 years, normal payment. It's $500, $506 a month. So like you said, the option are pay cash, write a check for the full 30. In this case, I wrote a check for $5,000 down, went to Chase or wherever and got a loan. And you described instead, you're going to go to the carrier, right? You go to your life insurance company, you borrow from them. And instead of paying Chase, I'm just going to send a check to the carrier, right? Same $506, but I'm borrowing at much more favorable terms, usually from the carrier, correct? And because and walk them through why. Like, why is Chase charging me 8, yet I go to my life insurance company and I'm paying less? Why is that?
That's a great question. It's a risk conversation. So when I have cash value in my whole life insurance contracts, the carrier, they know because they built the product that I'm purchasing from them, right? So they kind of know Kyle's got $100,000 in cash value here. So if I say, hey, I want a loan for 50, they're like, where do you want this thing? Like, they know I'm good for it. It's right there. They've got the financials. Now,
it's cash. In other words, it's pretty easy to loan against cash because if you don't pay, they just go, right? I mean, not a complicated thing on there. You're guaranteeing it essentially with cash.
It is the safest place for the insurance companies to lend because my policy is literally sitting with them, right? So I'm fully collateralized, and cash is the best source of collateral for loans. You got someone with a ton of cash, that's a very safe bet. Now, if the loan provisions, they're called unstructured loans. So there is no amortization schedule. You basically have an interest-only loan that you could extend for 30 years if you want it. So really favorable. And this is why you have to get your rules of banking down, because that can bite you if you're not disciplined. You don't got tough money habits. And so
but now real quick, I want to be clear on the criteria of this loan, Kyle. When I go to Chase, like I got to provide them stuff and my credit, and based on my credit, my loan cost is going to vary based on my credit my depth of my credit, my employment. But let's just say if I just lost my job and my credit's impacted, and I go to Chase, I may be able to get a car loan, but it's not going to be at 8%. It's going to be like hard money. I mean, it's going to be 13, or I'm going to have to go to a shark on my. So same scenario though over here. The loan rates are the same for everyone. They're just the best rate because it's cash. So if I've lost my job, got crappy credit or whatever, I still get favorable treatment because it's a different, and I think that's a huge point. People don't get that these loans you could do whenever, and it's based on the policy you have, not the individual.
Absolutely. So there is no credit check. They don't ask you what you're using it for, and there is no amortization. So when we're helping people build tough money habits, this is why keeping a certain amount of cash reserves liquid in your policies is so important. the best time to borrow money from a bank is when you don't have to prove that you need it, right? When times are good, that's when you want to go use the banks. And now I'll use policy loans for a lot of things, but a lot of my policy cash values, I heard you use the words recently, like, this is the liquidity reserve, and we don't use it for anything unless our family has to eat. That's when you'd go dip into this. It's there to protect you. So if I get into a position where I've jeopardized something and I have no other options, I lost my income, no job, no credit, it's destroyed, I could still go to the insurance company with no questions asked and get a policy loan to float myself through a 2008. And, the individuals that learn this later in life, this is when you start hearing things like, had I had known this stuff 20 years ago, things would be much different today. And so the loan provision is unbelievably advantageous to you as a business owner, as an investor, because you essentially get to create how and when you're going to pay these things back. Really favorable terms.
So now we've got our loan set up. So I'm aiming the $500 back in my bank. So at the end of this 60 months, I've net dollars paid the same, right? I would have paid Chase and I paid my policy. However, when I paid Chase, I've got a car. When I paid over here, I also have a car. But when I Chase, the money's gone. Now I paid my policy. That loan now was paid off early because it was at a lower rate, right? Actually, essentially, I paid it off sooner. But the overage got to go into my policy.
Correct.
Right. And so I ended up with an asset that I could use for the next one, right? Like I've got, on one scenario, I'm left with nothing in a car that's, I bought it for 30. Hopefully 5 years from now, it's worth 10. That'd be amazing. I go over here, I still have the $10,000 car, but I also have the 30 plus the interest. But by the way, that entire time, my policy was still earning the 3 or 4%, correct? Out there, or whatever, like it's still in play with the carrier.
Yep. Every
at some level.
In a guaranteed contract. So when I was buying this stuff 11 years ago, interest rates were still extremely low. You couldn't find places to store cash that had any type of yield, but insurance companies have been offering it for hundreds of years. It's sitting right there, but because the education, Brett, is just not there, people think like, 3 to 4% net rate of return, I'll just go buy real estate at 8. I'll go to the stock market for 9, whatever it is. Those are investments. We're talking about where you hold money, and specifically with a banker's mentality. When that light bulb moment goes off, everything will change for someone financially. It's like Gary's got that path of money. You can do 4 things: spend, donate, hold, and invest. Most people, where they hold wealth, Brett, liquid safe assets, it works. It's barely working for them. They keep it in such inefficient environments. That's why people hate to save, because they never see their savings do anything. But I got policies that a lot of times, some of my policies will beat people's investments, and it's not even an investment. It's a guaranteed contract. And that to me makes me a tougher investor as well. If I got this account that I can hold cash in, that always goes up regardless of what's going on economically, I'm getting wealthier every year. And not if, but when the opportunities come along, the resorts, we have cash or capital to go put down on these properties, make a big return. What are we doing with that return? It's going to go right back into our banking system, and we're going to keep this cycle going.
Well, I love where you went. You went right where I was going to go, which is people also, when you have the ability to pay cash for something versus financing it, there are times where you can get a better deal. The way I was able to buy this resort is there were people that were willing to pay more money than me. But I said, I'll tell you what I'll do. I'll close in cash. I can close in 3 weeks. And they were like, so this was not a small sum of money we're talking about. It was significant. But because I had the type of policy you're talking about, and I've been doing it, my first one's now, what is it now? My first one's 12 or 13 years old. And I got a second one with you that's pretty big, that's 3 or 4 years in. But those, and then I've got them on my kids. And, so all of those combine, I've got access to a tremendous amount of cash that when you want to go do a deal, you can save money, right? Like there's times where speed and efficiency matters, right? Someone needs, hey, I'll sell my house for $300,000. Cool, it's going to take me 45 days to do a loan. And they're like, dude, I'm in foreclosure. I need to close in 2 weeks. Well, cool, I can't pay $300 in that time, but I could pay $270 and I could close in a week. Well, what did we just do there? We made $30,000 just because we had the right structure. Now, what's that return, Kyle? Like, how, I mean, when you're saving, I mean, it's insane. In 45 days, or in this case, it's only for 5 weeks, you made 30 grand on the same thing you were going to do. It's a pretty, the numbers are going to be pretty staggering on that. So I think number one, capturing all the flows of your money is great, but then you start investing it, or you're using it as a vehicle to back up, kind of be a foundational lever that you can pull in your investing. And I mean, that's, we're getting into a higher level conversation, but it all links. But it starts with, to your point, you're saving your money somewhere. You could put it in, most savings accounts pay, now they're paying a little if you have them right. But, the other thing, Kyle, the vast majority of folks don't know that interest rates today on a savings account are, as we're the day we're filming this, around low threes, right? 3.5, 3.25. You might find someplace it's 4, and they're trying to just capture customers. But people don't realize that that's today. But there are some folks, even hear that, they're getting 0, or they're getting 0.04% in some. And so just when you say these numbers, I to your point, I'll hear someone go, but it's only 3 or 4%. I'm like, well, first of all, it's after tax. So let's start there.
Yep.
Secondly, it's not an investment. If you just this is a savings vehicle where you're flowing in money you would have done. You were storing it somewhere. And so it's just you're changing the storage place.
And it's a benefits conversation. I think most people are not maximizing the benefits they deserve with where they hold cash. So, you really helped educate me on, I had a lot of accounts at Chase Bank. And I remember you coaching me and you were like, hey, why do you have all these accounts here? You should find a smaller regional bank that's more relationship based. Like they'll actually get to know you. They're going to pay you more money because they want to incentivize you to move your money there. And they're just easier to work with. Even if you're, a big player, you're still nobody, just a bank like Chase. You have to be massive. And so you get tough money habits by finding more efficient places to store short-term wealth. Well, the benefits I get with a savings account and a checking account, which we have to use to operate, you get liquidity, like it's accessible, you get safety, and hopefully you get some type of yield. The yield I was getting with the regional bank you clued me onto was way more than I was getting at Chase. So I got an extra benefit by going over there. The reason I store most of my long-term cash in life insurance is because they give me a contract that's guaranteed for the rest of my life. That's a long time to get a guaranteed contract. It's completely liquid. It's private, so very few people have seen my full system of insurance policies. You're one of them, my estate planner, my brother, my wife, but it's a very private asset class. It's got a really competitive yield, 3 to 4% net every year. If you're in a 30, 40% tax bracket, that's like 6, 7%, and you get that locked in forever. And then you have this loan provision that you can borrow against those cash values on unstructured terms. It's phenomenal. You also get death benefit. You get legacy. So the same time I'm buying investments, I'm buying vehicles, we're doing family vacations, we're repaying our banking system. My legacy for the next generation is also being created at the same time. And not everyone's into that multi-generational wealth piece, Brett. But one of the cool things about whole life as well is you get these things like really funded. If your plan is to retire, you can convert these policies into passive income streams. They're a huge supplement to your Roth IRA, whatever other investment vehicles you have. We have clients that don't want to leave anything for the next generation, or maybe they don't have kids like you and I do. Hey, build up this banking policy and then spend that thing down in the later years and have a blast doing it. Your checking account will just never do that. And so it becomes a benefits conversation. It's just a more efficient place to hold wealth, just like you said.
And there's so many things we can't get into, the other benefits that you're touching on right here, right? That part where everyone's going to leave a legacy. Just which one will you leave, right? And, when some people say, well, like I'll hear that, Kyle, sometimes, they'll say, well, I don't have kids. So and I go, well, do you have things you care about on this planet? You got something you care about. You care about saving the seagulls, or do you care about some environmental cause? Do you care about such? Fine, give it to them, right? Or to your point, spend it down and give them part, but like it gives you all these other options to think about. So, Kyle, you've went down this journey now for a long period of time, studying wealth, teaching this now, and helping people build these policies that get them exactly what they want. And so tell me today, when you look at that library and this long experience that you've got to have and this great opportunity of seeing what didn't work with money, what did, when you look at it today, what does wealth mean to you now?
Wealth to me means abundance and or excellence in all areas of life. So like I got a strong spiritual purpose in my life. Like I look at like the American landscape. We live in the wealthiest country in the history of the world, Brett, and we have so much income and opportunity available to us. But the average savings rate of Americans is less than 5%. We make all this money, we just don't keep any of it. And if we
Well, by the way, it's not even 5. It's like less than 4, and it's doing this right now, right? We were at 5. Now we're the same. We're literally like I bet you I bet you the next report comes out, it'll be under 3 for the average American, less than 3%. They say.
I think you're right. And so it's one of those things like we hear it all the time. I want to invest, Brett. I want to invest. But if we don't get our path of money down, how much you're spending, how much you're donating, which is next one is how much you're holding or saving. If you can't get the third piece, you don't get to do any of the cool stuff at the end. You'll never be in the position to invest. And Gary's got a great quote from the Millionaire Real Estate Investor. What you do in the beginning of your money will dictate what you can do with it at the end. And if we never fix the front part of our money, we never get to do the really cool stuff. And it starts with savings. And so our company's on a mission to help impact Americans, help them increase how much they save, where they store it to get them more benefits. And once they're there, that's part of our tough money curriculum. And so that for me is like the spiritual part. So that's part of being wealthy, is having a strong mission in this life. And then, having the personal health. I need the money to pay for my garage gym memberships. I want to eat good foods. I want to have good mental relationships with myself, physical relationship. And then I'm a big family guy. So the family experiences. We were talking earlier about, you sent me a picture with one of your sons. You and him were on a vacation, just the two of you. And you said, I hope you be thinking about doing this. And I was like, how young should I start doing this? And you said, knowing what I know now, I wish I would have done this earlier. So, things like that, that's wealth. It's the experiences of life. It's the relationships in all areas of life. And, I love what I do for an occupation. I'll never stop doing this. I'll always teach in some facet. And so that to me is what wealthy is. When you have all those areas of life really dialed in, going, that's when you wake up and every day you just love every second of every day because it's fulfilled, it's abundant. And if you can live that, that's a life you never want to retire from.
Gosh, that's I asked this question to everybody: what does wealth mean to them, right? And I never get an answer that it was about the accumulation of the asset. Like it's never like, well, money is this thing that like. It's always the other things that matter that make life, really, really rich. I think that people also realize what good you could do with money. And just an example of my own life, this, that my dad had this emergency back surgery about over a year ago. And he was in this near our small town where I grew up, but we're in like a regional small town hospital for an emergency fusion back surgery. Kyle, they don't have the resources, right? So you're kind of get what you get, and they want to get you out of there. There was no recovery facility. And I had to bring like an air ambulance, like a plane in the sky, to medically air vac him to the Mayo Clinic and just get him out of there. And, it was against the doctor's wishes. And I had to sign something that if he doesn't make it, it's on me, and I'm his healthcare power of attorney. So there's a lot of hard decision making. But it saved his life. And so having the money, if I didn't have the money, I've got to do whatever. I mean, we're just there, right? It just is. And so, I was able to make a decision in seconds and go, that this reality is not our reality.
Yeah.
I'm not doing it. And it literally, and we're about to get into walk again here soon. And from, like he might not be here. And so just an example of money, right? Like you never know when you're going to need it. It's actually not all the things about buying a Maserati or all the crap that you might see on Facebook or Instagram, wherever you go, your social media that try to live, someone else's life. It's none of those things. It's shared experiences, taking care of those you love, leaving a legacy in whatever manner you want, and living, I love your 5 areas of wealth conversation. I think it's so important. So, as Kyle, we're wrapping up here, talk us through at the end here. I want to go through like these questions I ask everyone. Top 3 books that most impacted your life.
Love it. We still read these every year. for our company. So every January, we read The One Thing by Gary Keller. I was making $60,000 a year as an insurance agent. And when I picked up that book and applied it, it took me from 60 grand to $250,000 in less than 12 months. And so that book was like, you just cut out all the nonsense. You go all in on the one thing. And so we read that book every January as a team, and you get new insights every time you read it because you're growing. So that was the first one. The second one is The Compound Effect. And so we read that every February as a team. I believe that's
by Darren Hardy.
Yeah, that's an applicable life rule to everything: health, spirituality, wealth. Just get 1% better every day. You give yourself some time and you start to separate yourself from who you used to be and who you're becoming. And you also separate from the herd, right? And so time and consistency. And then the third one is The Go-Giver. The Go-Giver. And that's one of my personal favorites. It's a lifestyle, right? It's like, I love to take people to lunch. I enjoy being at the table and I want to be the one that picks up the bill because that's something that gives me fulfillment. Like I love to connect with people. And the whole premise behind it is like, just give more value than you're ever going to get compensated for and just live your life that way. Every interaction you have with a human being, leave them with more value than you would ever get compensated for. And you just start looking at people differently, relationships differently. And so those are the three that we read January, February, March of every year. We've been doing it for the last 6 years now. And those would be the three that I think really impacted most things for me.
Who's the Go-Giver author?
It is, let me find it real.
And I might be able to snag it real quick.
Bob Berg.
Bob Berg. All right. I love it.
Bob Berg.
Those three books, by the way, I read I'm 2 or 3 on my annual reading list. The One Thing by Gary is super special to me, as I got to sit in his masterminds for the decade or longer leading into that. And I got to see a lot of, he was teaching that material. A lot of the way he writes a book is, they do the research and they do all that. But he believes you take that and then you start teaching it. You start teaching the concepts inside the book. So I got to live the concepts. And then the book came out, you're like, oh my God, it's just, that's one of my favorite books. It's definitely one of my most recommended books. All right, Kyle, little different question. Best purchase last 12 months under $200. It's most improved your life.
Yeah, this one's interesting. I think it's just a phase of life. So, we have a lot of people reaching out to us, Brett, asking us to come out and bring infinite banking education, our tough money curriculum. And so I'm traveling what I think is a lot right now. And so I have like a $5 little like covers your eyes when you sleep. I don't ever wear these, but I got them because every hotel room's a little bit different and it's made my sleep so much better. And so that little $5 thing has added a lot of value to my life recently. So that's the one that I came up with is.
I love that one. I can tell you, I'm in the eye mask game, Kyle. Mine's $11. But I couldn't limit. I mean, I've tested all of them, right? Because I'm a nerd. I love that one. All right. So as we wrap up, Kyle, I want you to go and imagine you're talking to your 21-year-old self. And you're going to give him a 60-second, just all the lessons you can distill about this journey you've went on. What do you say to your 21-year-old self?
Yeah, I think what I would go back and tell my 21-year-old self is like, we did it and you got to just do it now. You're going to have fear. You just can't have any doubt. That's what I would tell myself.
You're going to have fear, but you don't need to how do you say it? You're going to have fear, but you don't need to have any doubt.
You're going to have fear, but you can't have any doubt. What we committed to do, we are doing it. We're on the path. It's going the direction we want it to go. You're going to be scared every day you're doing it. You just can't have any doubt. You can be afraid. You just can't have any doubt.
Yeah, Kyle, that is so good. So before we wrap here, I want to say a couple things. You mentioned this tough money, workshop that you guys have built. If the listeners are out there, they want to bring that workshop, whether that's a group of dentists, whether that's a real estate office, whether that's whatever, you go out and bring this 3-hour workshop, which people leave there just understanding how to use, I'm going to use your language, how to get tough with their money, how to have tough money. Give us a short version. What does that workshop, what does that look like when you go out there and do that?
Yeah, so we lead with a few banking concepts up front. We call it the vacation. Once you kind of see some like, what does it look like when you are the banker? I think people get really excited like, okay, that's Bora Bora. How do I go there, Brett? Well, you got to start saving some money. We got to start prepping for that vacation, right? And so we usually lead with like 90 minutes of infinite banking to kind of show them some really cool things they can do with their money. And then naturally it's like, okay, well, what do we have to do to get that done? And that jumps into a series of conversations around how much do you need to be saving? How much cash reserves do you need to be holding? Do you understand your debt to income ratio? Are you holding wealth in the right environments? And we go through what we call the 5 most important financial questions. And that's what the workbook entails. So those questions, Brett, are, do you know how much passive income you need to be earning to live the life you've always wanted? That's our big question. Question 2 is, do you know how much you should be saving to achieve your passive income goal? Question 3 is, do you know how much cash reserves you need to be holding to guarantee your protection and opportunities when events happen? Question 4 is, with the current environment where you hold money, are you maximizing the benefits you deserve? And the 5th question is, if you had to rate your current money management habits, would you say, I don't have any, they're weak, they're average, strong, or can you confidently say, I've got really tough money management habits? And the workbook will allow you to write your own wealth story into it so you know for sure that you have all of those things dialed in. If those things are dialed in, you will be successful at infinite banking. If those things are dialed in, you will be successful as a business owner and as an investor, an employee, self-employed. Tough money is very universal. And so that's kind of what they can expect. It's our one piece of educational curriculum, Brett, that we get more of our adult clients bringing their teenagers back for round 2, because they're like, if I would have had this at 15, 18, things would be much different. We would have millions more in our control today.
It's so good. So Kyle, if people want more Kyle, more Factum, or they want to bring the Tough Money Workshop out to them, where should they reach out to you?
I'm probably most active on Facebook, so they can just find me, Kyle Fuller, on Facebook. You'll see my background picture. It's our authentic family picture where all the kids are crying. It's not staged and everyone's happy. That's how family pictures go with young kids, and so you'll see it right away. You can go to our website, factumfinancial.com. We'll come right up. There's a few different ways. We're on social media, website, and I'm sure you'll link everything below on this episode as well.
Yeah, we'll put everything else in the show notes. Kyle, thanks for being such a rock star, man. I got to have you back, and we got to dig in. We'll go deeper in the tough money, but thanks for all you do to educate so many, and I greatly appreciate your time. Thanks so much. For all of our listeners, go out, have a huge week, and we'll see you back here next week for our next episode. Go out, be wealthy. See you next time.